Hi everyone, we're just going to give it another minute or so for a few more attendees to join. But do feel free to introduce yourself in the chat while we wait for a few more attendees. Okay, I'll just give it one more minute before we start. Okay, good afternoon everyone. My name is Nicola and I work at PayFit as a payroll specialist and a product legal advisor, and I'm hosting the webinar today. So the main focus of today is going to be the impact of last week's budget announcements, particularly around payroll and what it means for employers. Now, there will be an opportunity at the end of the slides for you to ask any questions. There is a box on the right-hand side of your screen where you can ask any questions. Try to use that if possible rather than the chat section. And the slides will be shared with you tomorrow, and the recording will be available from tomorrow as well. The slides will be distributed and they will also include the April 2021 rates for the likes of income tax thresholds, national insurance and statutory pay changes. So just before we begin, for some of you who may not know, we are PayFit and we are a payroll software. We launched in 2015 in France, which arguably has some of the most complex payroll legislation in the world. Since then, we've expanded into Spain, Germany, the UK, and most recently Italy. And we're currently helping over 5,000 customers improve their payroll experience. So our aim is to effectively bring payroll back in line with some of the more up-to-date softwares and products that you will see for the likes of HR and finance. We almost feel like payroll's been left behind slightly in terms of the look and feel of payroll and also how softwares are used and who can access softwares. Our aim is to give employers the benefit of owning and processing their own payroll data, but with dedicated payroll support from our in-house teams. We believe that all employers can run their own payroll without relying on outdated tools or outsourced models that can take control away from the employer without having to be a payroll expert. Our primary offer is that of a payroll solution that is simple and intuitive to use, even for customers who have never run payroll before. To enable us to do that, we offer automated real-time information submissions on an employer's behalf, automated pension submissions for many pension schemes, and also regular testing and reviews of payroll legislation to give our customers the most up-to-date features, including the likes of our automated furlough feature. We also offer HRIS, so employees can access their pay slips, their P60s and their P11Ds in their employee space, even if they've left the business. And they can also change their personal details and request things like unpaid leave, annual leave, and also expenses. Okay, so let's take a look at some of the changes announced in the budget last week. The first one we're going to start with is income tax changes, and it should come as no surprise that the budget included changes to the personal allowance and tax thresholds, because we do see this in some form most years. But this year it was announced that both the personal allowance and the higher rate threshold, which is the rate at which you pay 40% tax, is now being frozen until April 2026. And we haven't seen something like that announced in the budget for quite some time. So what does that mean? In a nutshell, the freeze means that if you keep earning the same amount, you're on the same tax code for the next 5 years, then you're not really going to see a difference. This isn't going to be much of a change for you. But the likelihood is that in the next 5 years, your salary will increase. And if salaries are increasing, but tax rates and thresholds do not, employees will effectively pay more tax. For this year, this is currently applicable for England, Wales, and Ireland. But do remember that Wales do have the power to change their own tax thresholds, and they may do so before the freeze ends in April 2026. Next, let's take a look at corporation tax. So whilst it doesn't directly link to payroll, it does impact the majority of businesses in some way. So what did the budget change in relation to corporation tax? Well, the biggest change is that there will be an increase in the corporation tax rate from 19% to 25% as of April 2023. But despite how intimidating the 6% increase may seem, this isn't going to impact all businesses. In fact, according to the government, the increase is only going to impact around 10%, or at least the full increase is only going to impact around 10% of businesses. And that's because the 25% corporation tax rate will only be applicable for companies whose profits exceed £250,000. For those companies whose profits are under £50,000, the 19% corporation tax rate is going to remain in place. That will not increase, but it will be given a new name of the small profits rate. And those companies with profits under £50,000 actually account for 70% of businesses in the UK. Now, if you're wondering, maybe your company sits in between, maybe the profits are over £50,000 but under £250,000, then there will be a tapered rate set that hasn't been confirmed yet in between the 19% and the 25% rate. So it's estimated that the actual 25% corporation tax rate will only apply to around 10% of businesses, and any rate above 19% but below 25% is going to account for about 20% of businesses. Next, let's take a look at pension threshold changes. Now, these weren't necessarily announced as part of the budget, but given the impact on employees' pay, I did want to raise the changes so that employers are aware that they do have duties they need to complete in April. Now, this is applicable if your pension scheme uses standard qualifying earnings, which is currently pension schemes that base their pension contributions on earnings between £520 and £4,167. These will increase from April, meaning that pension contributions will be based on earnings between £520 and £4,189, which is an increase of about 66 pence based on standard minimum employer contributions, where employees' earnings are above the pension threshold. For employers, you're going to have to make sure that your payroll software is up to date with these changes. At PayFit, we handle these things on behalf of our customers, so there's no need for employers to have to do anything to have that rate increased. But it may be worth communicating with employees to advise them of the changes just to minimise your payroll queries in April payday. So shortly before the budget, we did have confirmation of the national minimum wage rates and that they were changing, as they do each year, in line with inflation, to bring the national living wage rate to £8.91 and also increase the national minimum wage age-related rates. Now, this was an expected change. We do see this every year because the Low Pay Commission has a goal of raising the national living wage to £9. But what has also changed are the bands that the national minimum wage rates apply to. And this is the change that employers need to be mindful of, because we haven't seen this change for a while. So from April 2021, the highest national minimum wage rate, which is the national living wage, will be paid to employees who are aged 23 or older, and the rate will be £8.91. Previously, the national living wage rate was applicable for employees who were aged 25 and older. So because of this, employers need to identify the population of 23 to 24-year-olds previously receiving the lower rate and make sure that these employees are receiving at least the higher rate of £8.91. There are also increases to other national minimum wage rates and bands that you'll need to be mindful of as well. It's also worth noting that when we do talk about national minimum wage rates, we don't necessarily refer to the hourly rate of pay that is stipulated in your employee's contract. If you have an employee whose pay is equal to or just over national minimum wage, things like salary sacrifice deductions can lower their true national minimum wage. So when you're uplifting your employees' minimum wage rate, it's important to look at their overall gross pay they receive for the hours they work to be sure that they're not receiving less than the minimum wage that they're entitled to. So a change that payroll has been known about for some time, and that was confirmed as part of the Scottish Budget, was the introduction of the fourth student loan type, which is Plan 4. Plan 4 is the new student loan type for both current and new Scottish borrowers. That will be separate from the other three student loan types. It will have its own threshold and it will have its own deduction rate. Now, from April, there won't actually be much for employers to do. Those who are currently on a student loan plan, which for Scottish borrowers tends to be Plan 1, the HMRC will be sending notifications where the plan type needs to change. For those who use PayFit, if you have your HMRC notification set up as automated, this will happen on your behalf. The only thing that employers really need to do is, if they have any new starters, make sure that your new starters are filling in the correct and updated starter checklist, where employees can choose from one of the 4 student loan plans. So on this slide, I just wanted to highlight the thresholds for Plan 4 and also the changes in the rates for the other student loan plans this year. Plan 1 and Plan 2 have seen an increase on the threshold before student loan is payable. However, postgraduate deductions have stayed at the same rate and the same 6% deduction as previous tax years. Plan 4 will offer the second highest of the student loan thresholds at £25,000 per year before student loan is payable, but it will mirror the deduction rate of Plans 1 and 2 at 9%. Next, we have the national insurance relief for veterans. We did expect this to come into effect from April 2021 because it was announced in last year's budget, but it is nice to have a new positive initiative confirmed by the government. So what is it? So the government has created an initiative to encourage employment of ex-armed forces employees that are individuals who have served in the Army, the Royal Air Force, or the Navy. So what does it offer? It offers employers the ability to reclaim their employer national insurance that they have paid for those ex-armed forces employees that they have employed. In order for an employer to be eligible for this, the veteran needs to have served at least 1 day of employment in the armed forces. In terms of entitlement, employers can reclaim employer-only national insurance, so no employee national insurance, on employer contributions up to the secondary threshold. So any employer national insurance you have paid on the first £4,189 of earnings. And this is for the first 12 months of the person's employment. Now, in terms of how to claim, from April 2022, this will be reclaimable via real-time information, so it will be able to be reclaimed each month via the monthly EPS or FPS, the HMRC are yet to confirm. However, for the tax year beginning April 2021, the claim will be made retrospectively using a HMRC service that they will be releasing further information on for us shortly. Now, at the moment, there's no action for employers that they need to take in regards to their claims. What will be helpful is making sure you have any accurate records of employer national insurance that you have paid on behalf of any employees who fit into this category. And also, for record keeping purposes, you may want to start requesting evidence of armed forces employment from employees when they start your employment, as suggested by the HMRC. So the next budget announcement we'll discuss is the "I'm shocked but I'm not surprised" extension of the coronavirus job retention scheme. Now, this will be a welcome relief for many employers whose businesses are still very much impacted by the COVID-19 restrictions, but the extension does come with changes that employers need to be mindful of. So let's take a look at what these changes are. So April 2021 marks the last month of the furlough scheme as we know it. The first change takes effect from the 1st of May 2021. Now, at the moment, if your employees were on a real-time information submission from the 20th of March 2020 to the 3rd of March, the 30th of October 2020, they can be furloughed. However, the HMRC have decided to extend this, so now that employees who were on an RTI submission between the 20th of March 2020 and the 3rd of March 2021 can be furloughed, which means if you have employees who started employment in maybe November or December or January who have not been able to be furloughed but maybe currently laid off or on reduced working hours, they can now be furloughed provided they were on a real-time information submission, which was a change that many companies were hoping for. Now, if we move to July 2021, employers are going to have to recommence their mandatory contribution of 10% towards furlough pay, much in the same way as they did last year, as the employer is only going to receive a 70% contribution from the HMRC. In August, this will change again, so employers will need to contribute a mandatory 20%, with the HMRC contributing 60% of furlough pay. And the 30th of September 2021 will mark the end of the furlough scheme. Now, just on this topic, I have been asked in nearly all of the webinars that I've done since the furlough scheme came into place, if the furlough scheme will be extended again. And whilst I don't like to sit on the fence about these things, I just don't know. But I do think that we could safely assume that we probably won't see furlough return to the full 80% contribution from the HMRC. Now, that brings us to the end of the section where we discuss the budget changes. Employers certainly have a lot to think about for the new tax year, as they always do. You know, the end of the tax year is a very busy time for employers. Now, your payroll software may take care of most things. For example, tax threshold changes are handled automatically by the PayFit app, and any employees not receiving the correct rate of pay, falling below the minimum wage, are flagged so that employers can correct their employee pay. But now we've talked about the changes that employers need to consider ahead of the new tax year. But before you do this, you need to close down this tax year so that you can start afresh on the 6th of April. So what do employers need to do? Now, luckily, some of the things that you do need to do for the tax year in, year out, have the same deadlines, and these don't change. So the first is the final full payment submission, which is submitted no later than the final payday of the tax year. And it's the final report that you send to the HMRC that confirms your employee's year-to-date pay and deductions information. The HMRC ask that you confirm via the FPS that this is the last submission of the tax year, so the HMRC can start processing these year-to-date figures in their tax calculations. If you manage your own real-time information submissions, your payroll software should give you the option to select that this is the last submission. If you use the PayFit app, we will do this on your behalf. Next is the final EPS. So the EPS is an employer payment summary, and it's sent to the HMRC if you recover things such as statutory pay, if you've claimed things such as the employment allowance or deductions suffered under the construction industry scheme, or you are a larger company where apprenticeship levy is due. If you do miss the indicator to the HMRC that it was your last FPS for the tax year, you can use your EPS to do the same. So please remember that if you claim employment allowance and you haven't done so yet, this will be your last opportunity of the tax year to do so through your EPS. Next are P60s, so the end of year tax statement that we give to those who are employed by us as of the 5th of April. And it is an employee-only document. It's not something the HMRC receives, and it needs to be with your employees by the 31st of May. And it details things such as the year-to-date earnings and tax paid, any statutory pay received in the tax year, and any year-to-date national insurance contributions and student loan paid to date. And then finally, we have probably the largest end of year end of tax year task that we need to do, and that is the submission of P11Ds and your P11DB. So if you have benefits in kind that you provide to your employees, then you will need to send a P11D to the HMRC if you don't payroll your benefits, so that the HMRC has an understanding of what benefits you have offered to the employees and how much tax is due on that benefit. The HMRC will then use the P11Ds to amend your employee's tax code in the next tax year to claim any underpaid tax. Your P11D P11DB should also be sent to the HMRC as well to detail how much Class 1A national insurance is due on the taxable benefits you have provided. Now, if you are attending the webinar today and you payroll your benefits, you don't need to provide a copy of a P11D to the HMRC, but you do need to provide a written statement to your employees by the 1st of June 2021 to confirm what benefits they have received and what the value of those benefits are. Now, it may seem that you have a lot to cover at an already very busy period, but if you use a payroll software, many of these tasks can be much less time consuming. PayFit, for example, automatically produces and distributes employee P60s, and if our customers wish us to, we can send P11Ds to the HMRC, which saves time on those admin tasks. But now let's just add another layer into the tasks that an employer needs to include. So you have the budget changes, you have the end of tax year changes, and then you have your start of tax year changes. So let's just take a look at your start of year duties, most of which start on the 6th of April. So the first is payrolling benefits. If you've decided that the P11D process is taking too much time, or you feel like you could improve your benefits processes, then it might be time to payroll your benefits, and you can do so by registering with the HMRC by the 5th of April 2021 for this upcoming tax year. It will remove the need for P11Ds for most benefits, and your employees will pay the tax on these benefits each month through the payroll rather than through their tax code in the next tax year. In order to do this, you must register by the 5th of April 2021. So next is employment allowance, and in prior tax years, once you had selected that you needed to claim employment allowance, there was no need to do anything else in subsequent years. However, now each tax year, you need to assess your eligibility for employment allowance, because remember, it's not available to all employers anymore. And if you do want to claim employment allowance, you will need to do so by your employer payment summary via your payroll software. For most payroll softwares, it's as simple as activating a toggle or selecting yes from a drop-down menu. And then when your EPS is sent for the tax year, the HMRC knows to apply your employment allowance offset to your HMRC account. And next we have implementing new legislation. So this links quite nicely to our budget slides. You know, most years there are changes to make to statutory pay rates and national insurance thresholds. Sometimes this can be a really straightforward process if your payroll software takes care of this for you. At PayFit, we make sure that any rates are increased on our employer's behalf, and any tax code changes are automatically processed on our employer's behalf. But if you do have a more manual payroll software or manual payroll processes, you may need to make sure that these changes are completed manually. So make sure that you do that before your April payroll runs. Now that brings us to the end of our presentation. I really do hope that it's been helpful for you in understanding what the changes are that employers are facing as a result of the budget announcements. We're going to move to our Q&A now to see if we have any questions to answer. And please remember, if you are already a PayFit customer and you have a question about our tax year end processes, you can refer to our newsletter that's been released today showing our new tax year end feature. And you can also contact our customer success team, and one of our customer care managers will be able to support you with queries you have around the app. So let's take a look at our questions. Okay, so we have two questions. The first is, will the P60 be sent by PayFit directly to employees? So yes, there is a section in the app that you select which documents you want to be sent to your employees. And if the P60 is selected as being a document you want to be sent, then it will be sent on your behalf directly to the employee space in exactly the same way that they would view their pay slip. And this is the same for P11Ds as well. If you want us to send P11Ds on your employee's behalf, we will do so. So we'll send them to the HMRC, and they'll also be available in the employee space to view. So I'll just hold on and see if we have any more questions come through. So just to recap on what I said at the start as well, so any changes to rates and thresholds such as income tax rates, national insurance rates, statutory pay rates, I've included at the end of the slides that will be distributed to you, so you have a reference to them there. There is also a section on IR35 as well. I appreciate that we haven't covered it in this webinar, because there have been a lot of webinars. We covered it in our last webinar on the start of the tax year. And there's a lot of resources available on that topic now, but I have put some slides together just for reference, because that is still a change that is going ahead in April too. Okay, we don't seem to have any more questions coming through. Oh, no, we have. So we've had a question from Pauline saying the chat box is visible, but none of the messages. Do you mean the questions that, have you asked a question, Pauline, that isn't visible? So I can see that we do have some questions that have come through that I've answered, and I can see them. If someone feels that they can't ask the question in the questions box, please feel free to try and use the chat box, and we'll see if they come through on there. If not, you can always get in touch with us directly, and we can answer any questions that you have around the webinar. Okay, so Pauline, the questions, so I'll have to double check if it says the questions will be visible to all attendees, because I can certainly see them. I'm not sure if we have any issues in the visibility of them. I could certainly find out for you. We have had a question come through from Marianne, who says that the September furlough is that 20% like August. Yes, so the 20% mandatory employer contribution will be from the 1st of August until the 30th of September. It's not going to reduce anymore, and it's not going to increase. It will stay the same until the end of the scheme. Okay, we've had another question on P11Ds and would they be sent automatically to employees? So yes, we have a section in the app where you can select what documents you wish to be sent directly to employees, and P11Ds can be one of them. Okay, I'll just hold on for another minute and see if we have any more questions to come through. But don't forget, you can get in touch with us if you have a question that you think of after the webinar, or something that you haven't wanted to ask on the webinar, and we can make sure that we can provide an answer for you. Okay, so we don't seem to have any more questions coming through, so I will bring the webinar to an end. But just to reiterate, I really appreciate the time you've taken today to come and listen to me. And I do hope that it's helped with your kind of end of tax year and start of year processes. And do get in touch with us if you have any questions around the budget announcement of any tax year end processes or the PayFit app itself, and we can help you as best we can. Thank you. Bye bye.